If advertising a loan, which of the following would violate truth in lending laws? An assumable loan, FHA financing available, no down payment required, easy financing terms. No down payment required. No down payment required triggers the truth in lending disclosure because it is a specific statement about only one aspect of financing. Easy terms does not trigger the regulation because it's not specific. The discount points charged by a lender on a federal VA or FHA loan are a percentage of the A. Down payment, B. Loan amount, C. Appraisal price, or D. Sales price. Loan amount. Like points, discount points are one-time charges equal to 1% of the loan amount for each point charged. A borrower takes out a mortgage loan that requires monthly payments of $875.70 for 20 years and a final payment of $24,095. This is what type of loan? A wraparound loan, a variable loan, a balloon loan, or an accelerated loan. Balloon. A balloon payment mortgage is a mortgage which does not fully amortize over the term of the note, thus leaving a balance due at maturity. The final payment is called a balloon payment because of its large size. Balloon payment mortgages are most common in commercial real estate than in residential real estate. Lenders use a debt-income ratio as a method of setting escrow fees, a loan qualifying tool, government loan ratio, a way of calculating your net worth. Loan qualifying tool. A debt-income ratio is used by lenders as a loan qualifying tool. It is a method of calculating how much debt is owed in relation to how much income is coming in. When the deed in which you take title of the property contains the following clause, subject to an existing loan. The lender is guaranteed that you will pay off the loan. You are in danger of losing the property if the seller does not make the payments on the underlying loan. The seller is permanently relieved of liability. You agree to assume to the loan and make the payments directly to the lender. You are in danger of losing the property if the seller does not make the payments on the underlying loan. Buying subject to means buying a home subject to the existing mortgage. It means the seller is not paying off the existing mortgage and the buyer is taking over the payments. The unpaid balance of the existing mortgage is then calculated as part of the buyer's purchase price, but the seller remains responsible for paying off the existing loan because it's still in their name. Which of the following statements about the housing loans with federal government support is false? Federal Veterans Affairs loans guarantees may be used for condominium financing. FHA may insure mortgages for either apartment house projects or single-family residence. The federal government insures the lending agency against losses. The federal government supplies funds to the lending agency. The federal government supports many aspects of the home loans to make it easier for citizens to purchase homes. For example, the FHA insures lenders of federally backed against loans mortgages of single-family residence and multifamily properties, and VA-backed loans may be used to purchase condominiums. The federal government does not, however, supply funds directly to lending agencies. Note, this question asks which of the following statements is false. And it's false that the federal government supplies funds to lending agencies. Which of these federal laws requires that finance charges be stated as an annual percentage rate? Equal Credit Opportunity Act, Truth in Lending Act, Federal Fair Housing Act, or Real Estate Settlement Procedures Act. Truth in Lending Act. The Truth in Lending Act of 1968 is United States federal law designed to promote the informed use of consumer credit by requiring disclosure about its terms and costs to standardize the manner in which costs associated with borrowing are calculated and disclosed. If a note is taken as earnest money, it is the seller's best interest to have a note payable within 72 hours before closing, at closing, on the first banking day after the buyer takes possession, upon the seller's acceptance. Upon the seller's acceptance. If a note is taken as earnest money, it's the seller's best interest to have a note payable upon the seller's acceptance. David sold his home and agreed to take back a note and a trust deed as part of the purchase price. He wanted to have the note become due and payable if the property is resold. To accomplish this, which of the following clauses should be in the note or trust deed? Substitution clause, deficience clause, subordination clause, or alienation clause. An alienation clause. An alienation clause is a clause in a financial contract that comes into effect when the ownership of a specified asset is transferred or a collateral property is sold. Alienation clauses are common in mortgage contracts providing full repayment if real estate property ownership changes. The interest rate on a real estate mortgage is fixed by the federal government, regulated by U.S. Treasury, determined by competition between the money and the capital markets, fixed by the State Real Estate Commission. Determined by competition between the money and capital markets. The interest rate on a real estate mortgage is generally determined by competition between the money and the capital markets. When processing a real estate loan application, a lender would correlate the characteristics of a borrower, loan, and property to make a property appraisal, a loan commitment, a credit rating, or liability statement. A loan commitment. In determining whether or not to make a loan commitment, a lender will examine the borrower's income, their character, and the property. When a lender speaks of discounting, the lender is probably referring to the process of determining the effective interest rate, the difference between the nominal interest rate and the effective interest rate on a specified loan, the process of determining the actual yield of a given loan by adjusting the variable interest rate, the loan proceeds disbursed by the lender are less than the face value of the note. The loan proceeds disbursed by the lender are less than the face value of the note. Discounting is selling a note for an amount less than what is owed. The terms of some real estate loans provide that the interest rate may be increased or decreased depending on money market conditions. We call this type of loan a loan which is secured by a short-term land contract, an interim loan, a variable interest rate loan, a fluctuating market condition loan. A variable interest rate loan. A variable interest rate loan allows for increase or decrease in the interest rate on the loan based on money market conditions. The security interest is best defined as the interest payments on a conventional loan, The use of stocks of bonds or other securities as collateral for a loan against real property. The creditor's interest in the debtor's property. The interest on an assumed mortgage. The creditor's interest in the debtor's property. The creditor maintains a security interest in the property of the debtor. Lenders know that the lower the loan-to-value ratio, the higher the amount loaned, appraised value, equity, probability of default. Equity. Loan-to-value ratio is a ratio of the percentage of the appraised value of the property that the lender will loan. The lower the ratio, the higher the equity.